All right, the iron butterfly. Now this is where we're going to create more of a defined risk type of strategy with the straddle. The iron butterfly is nice because you have a defined risk parameter. It is a market neutral strategy. We don't want this market to go quickly in either direction. We really would like to see it flatline straight across the board and trade at 60 for the next 50 days. Highly unlikely, but we want to take advantage of the time decay or the theta decay in this kind of strategy. The trader of the iron butterfly is looking for the trade at the short call and put price at expiration, which is, we will show a chart of that in a little bit, but it's at the peak. And it's going to be similar to the straddle, like I said, with limited risk. And you can pick your risk parameters depending on how much risk you want to take on these. You can push it way out just to make sure that you can put it in an IRA and still take advantage of more of a credit received. But we're going to be selling the money straddle and buying the wings, which makes it the butterfly. The base is going to be the straddle. The wings are going to be our defined risk. And we're going to be buying an out of the money call and an out of the money put, usually at equal distance from the straddle strike prices. You can make it however you want, but usually this goes with the same strikes going further out, which limits the risk of the short call and the short put of the straddle. So this is a strategy that one could put in an IRA because it has defined risk. It's implemented in low volatility environments with the expectation of continued low volatility. That's very important. We don't want to see volatility expand when we put on this strategy. And in order to take advantage of the theta or the time decay. That's the major thought process in this strategy. The max profit is achieved when the underlying is trading at the strike price of the short options, as we mentioned, even with the straddle. And the max profit is the net premium received minus your commissions paid. And remember, I don't have the commissions paid in all of these slides, but that is something to be very conscious of with these four-legged strategies, depending on how much you're paying. And the max loss is with limited risk. Unlike the naked straddle, we've created defined risk. So there's two max losses. The max loss is going to be the long call minus the short call minus the net premium received. And the max loss on the put side is going to be the short put minus the long put minus the net premium received. The break even, again, there's two. The break even for the short call is going to be the short call strike price plus the net premium received. And the break even for the put side is going to be the short put minus the net premium received. As you can see from this graph of the iron butterfly built upon the straddle, where we sold the 60 straddle and we got a credit of $3.96, and then I bought in the two defined risk sides where I bought the 55 put and the 65 call for a total of 72 cents. So that would be taken away from our credit received. So we would totally gain a $3.24. It's a little bit less, but we have a lot less risk, and that's, in my eyes, kind of worth the price to pay. I mean, we didn't pay a lot for those, but we have defined our risk. The break even is where the line crosses right at one standard deviation, and our defined risk is a little bit lower. So you can see that what our max loss would be.